Hi, I am Anil Kothari from the research team at MFA, and you're watching the story of our markets. Let's begin with the global picture. November turned out to be one of those months where the global macro data didn't exactly disappoint, it just didn't excite anyone either. Think of it as a buffering month for markets. The broader financial markets continued this cautious, slow motion transition, waiting for clarity from central banks and geopolitics. In the US, bond yields barely moved, almost as if they too were waiting for the Fed's meeting in early December. For now, the street is leaning towards a 25 bips rate cut. But with the recent government shutdown causing delays in releasing inflation and employment data, the Fed is missing some of the usual checkpoints. On the geopolitical front, President Trump has been pushing quite actively for a peace agreement between Russia and Ukraine. Talks are underway, but for now, the world watches and waits. On trade matters, the US has signed a zero tariff agreement with the UK specifically for pharmaceutical products, a move that could shape sectoral flows over the coming quarters. In Asia, Japan stole some headlines. Its 10-year government bond yield touched 1.84%, which immediately raised concerns around the unwinding of the famous yen carry trade. Inflation there is now near the 3% mark, which means cheap Japanese money flowing into risk assets globally could face some pressure. And of course, if November needed any more drama, Bitcoin obliged, slipping dramatically from its highs near 126,000 US dollars to almost 80,000 US dollars. US equities gave up some early month gains, but nothing alarming. The US 10-year yield hovered around the 4.08% mark. Gold, after taking a breather in October, recovered most of its lost ground. Oil stayed in its familiar range between USD 60 to 65, practically the one adult in the room refusing to be volatile. Overall, November delivered a healthy dose of noise and volatility across global markets. When we look at the global numbers, they were mostly steady. The kind of data that neither excites nor alarms the markets. The US PMIs stayed in expansion territory, Europe held broadly flat, and Japan showed a marginal uptick in services activity. So overall, the global growth picture remains stable, but without any major sparks. Back home, the data also painted a mixed but generally encouraging picture. GST collections stayed healthy. Q2 GDP delivered a strong 8.2% growth, and services activity continued to expand well. Manufacturing slowed a bit and industrial production softened, while inflation cooled meaningfully, a relief for both consumers and policymakers. FIIs remained sellers through the month, but DII stepped in aggressively and kept the domestic flows resilient. Now let's look at the key risks. Any escalation in global geopolitical tensions or unexpectedly strong US macro data may strengthen the US dollar, which could introduce volatility across emerging markets. As we head into the Q3 earnings season, markets continue to stay near their all-time highs, slipping occasionally but refusing to break down meaningfully. The depreciating rupee has acted as a soft cap on a breakout move, but nothing structural has changed. We believe earnings momentum should improve meaningfully by Q4. Last year's low base is likely to support a double-digit earnings growth trajectory for corporate India. A rate cut by the US Fed would also mean easier liquidity conditions, which is constructive for global equities. Adding to that, any positive progress on an India-US trade agreement would likely trigger strong FII inflows. So our view stays steady. Any meaningful dips in the market continues to be opportunities to accumulate, especially with improving macro conditions, a supportive earnings cycle ahead, and policy tailwinds lining up. That's it for this edition of the story of our markets. Thanks for watching, and as always, stay invested, stay informed. Thank you.